Welcome back, investors. Today I am biting the bullet. I'm going to analyze Tesla's stock. And I just want to preface, I'm by no means trying to say I'm a professional in stock analysis or I have any experience with Wall Street. I'm just an average accountant with an MBA and just enjoys looking at different companies. I like reading through the annual reports, looking at the numbers, and trying to make sense of it. And so, none of this is investment advice, but I just wanted to start this channel so that, maybe at least some of what I know is useful and can help people. And the things that I don't understand, YouTube's a great place to get pretty instant feedback when you're wrong. That to say, on my last video, I did make an error in describing some stuff about penny stocks, and you can read through the comments and see where I was corrected on that. But that's the thing. I appreciate that feedback and making sure that, what I'm saying is accurate. So definitely, like I said, I appreciate feedback. So put those in the comments, and I try to be really good about responding as quickly as possible. So like I said, I'm digging into Tesla today. I've kind of put it off for a long time, and I think it's because as someone who's really, I started with Benjamin Graham as a value investor, and I've tried to slowly build towards like that Philip Fisher, Warren Buffett style of moving from quantitative to qualitative analysis. And as a value investor, with a company like Tesla that isn't just a standard automotive company, they really focus on technology. They trade like a technology company. They're valued like a technology company. So it makes them challenging when you're used to looking at, tangible book value and those kinds of things to try to determine whether it's a good buy or not. And also, it doesn't pay a dividend. They have no interest in the foreseeable future of paying a dividend. And I think I've used that as an excuse as well to not evaluate it. But I finally decided I'm going to. I think there is some interesting stuff going on over at Tesla, and so I wanted to dive into that with you guys. And like I said, hopefully I can learn some more about one of the biggest companies in the world, and kind of what makes it so special, what gets people so hyped up. And so here, if you look at the across the top there, I've got that row frozen so that it's going to be with us the whole time. But essentially, that far left column, that's your factors. The middle five, for a lot of data, I wanted to make sure I had 5 years worth of information so that I can we can try to find some trends. And then that far right column, I just added in compound annual growth rate, CAGR, and wanted to use that for a couple things. If you don't know the difference between average growth rate versus compound annual growth rate, then or average growth rate, definitely go and look into that. A big part of it has to do with the fact that an average growth rate is just completely linear, so it doesn't look at certain aspects of how investments perform over time, and so you'll get different results with those. That's why I decided to use that compounded growth rate. I didn't want things to be skewed by linear data, but I don't think we'll have that problem anyways. Looking at Tesla, things are pretty straightforward. So I always start looking at the ISS governance scores. The more I look at those, the less I use them so much, but it's always interesting to see how the ISS organization is ranking these things. So it's a 1 to 10 scale, 1 being the best, 10 being the worst. They look at audit, board, shareholder rights, and compensation. So everything's in the 8 to 10 range. Not great, but it's just like any analyst's opinion. You got to take it with a grain of salt and really dig in for yourself to decide where you stand on it. So just putting that out there. Looking at their margin and their returns, actually pretty solid here. I've looked at a couple companies that either had, negative margins or returns, or, single digits, but I like to always see at least a double digit of some sort, even if that's in the teens or the 20s. And Tesla falls right in there. Nice positive margins, return on assets and equity, right almost to 30% on return on equity. So definitely a good place to be at. That shows effectiveness by the management team, that they're running the organization well. They're making sure that they're getting the most bang for their bucks for their investors. So that's a really good positive start when we're looking at the numbers. Currently trading in the 250s. I haven't looked at it here later today, but that's kind of where it's been at. If you look at the stock price since 2018, of course, you got to factor in, the fact that there was a really big stock split. I think it was last year. Definitely correct me on that if you need to. So again, factor that in, but kind of going, from $20 up to $350 in 2021, and then 123, and then back up to 257. So mostly an upward trend. Again, there was that stock split, so I could definitely be wrong on this. I think it was it was well past $300 a share. I thought at one point it got to 600, but I don't want to say something really stupid here. Just speaking off the cuff. And just to clarify, I video these in just one take. Literally video these on my phone. I don't do really any editing to this. So occasionally, like I said, I'll say something and I'm like, man, okay. And so I try to do better each time. Someday I'll probably get to where I have time with kids and my business and my full-time job and stuff to really do, really technically specific types of videos, but currently that's not the case. So hopefully you're still getting something out of this, even if occasionally I end up on a tangent like that. So looking at trends in earnings per share, I needed to have corrected that. You can't do a compounded average growth rate if you have negative values. So really I needed to have started it in 2020, and instead of running it for 5 years, should have ran it for 3. So that's my mistake there. Regardless, if you just look at those 5 numbers, definitely moving in the right direction there. Consistently higher earnings per share on an annual basis over the last 5 years. So definitely move in the right direction there. Their price earnings, of course. So for me as a value investor, I don't like seeing anything over 20. I love less than 10. But a company like Tesla, again, it's not a typical just auto manufacturer. They are more of a tech company. And so, running in the 70s really isn't terrible. Some companies you see up in the hundreds. So, of course, I'd like to see it lower to know I'm getting a better bang for my buck. But, investors are willing to pay a premium for this company because they really have a lot of belief in it. So PEG ratio also pretty high at 2.86, suggesting that the rate of growth on the price earnings is not, justified at current costs. And you want to see less than 1 there. 2.86 isn't terrible. I had a stock I was looking at a couple weeks ago that was at like 7. So 2.86 isn't terrible, but again, really want around 1 or less than 1. Your price per book, I was really surprised to see this positive trend in book value per share. So they're currently at a price to book of 17. It's one of those things as a value investor, I don't like seeing over 2.5 on the high side, but they have a really nice 51.23% compounded average growth rate for the last 5 years on their book value per share. So they're really ensuring that they're putting a lot more into tangible assets. Part of that has to do with building these gigafactories and such. There's a lot of tangible assets that are involved in this company, and that's something you want to see, not just intangible trademarks and things like that. They have more on their books that's there. And of course, book value is only so useful because it is really a metric that tells you if they liquidated tomorrow, how much money you have a claim to. So that to say, Tesla's not liquidating tomorrow. I don't see that happening for a long time if it ever happens. They're a very solid company, and I think the consumer sentiment is buying in more and more, and that's only going to continue to strengthen the company's competitive position in a really tight market space. Their price per sale is really high at 10.45. Again, I think with the development they're doing, the fact that they're really starting to ramp up their revenues, it might be justified, but again, you don't want to see more than 2. So 10.45 is really high. Their revenue growth, 30.58 compounded average growth rate for 5 years. Really just every single year putting up better numbers. Went from 21 billion dollars in revenue up to $81 billion. So that's a really strong trend. Operating margin also following that directly. That means, they're not constantly piling on more and more expenses for each dollar of revenue they're trying to earn. They're keeping things in line and actually keeping their expenses down very well. So consistently, growing. Negative 253 operating margin back in 2018, and that net operating income went all the way up to 13 billion by this last year. So 179% increase there, compounded annually. So phenomenal growth actually happening. And so really kind of justifying what people are getting out of that stock price moving up. I don't know that it's unjustified. That's always been my worry. I think when I was looking at Tesla and kind of being skeptical of it is there really growth happening there? And truth be told, they're definitely making it happen in that company. And, we'll see here, if you look down at kind of near the bottom of the page, I didn't put anything on market share, but right above that, insider ownership's at 13%, which is really, really high. That shows a lot of confidence in the company. Granted, I know a lot of that is probably Elon's shares, which we'll touch on that as well. But that to say, I think the employees buy in. They have a lot of good initiatives for bringing in more talent and building on the talent they have. So definitely in a good spot, I think, there. As far as past 5-year growth, this is on Yahoo Finance per analyst. So past 5-year growth at 80%, and then the next 5 years only projected at 10.66%. So we'll see if that lives up or if they can continue to roll out innovative stuff that really continues to move the company in that same direction. Operating cash flow, levered free cash flow, both positive numbers, which is, again, you want to see that. You want to see that money's coming in beyond just their expenses. So they're doing good there. I don't have a trend for that, but, that's something you want to see continue to go up. So I did something a little different here as we're looking through working capital over to capitalization. So current ratio and quick ratio, both of those relatively flat, 13% compounded average growth, 15%. But really, if you're looking at the numbers, there's not a solid trend, 0.83, 1.1, 1.8, 1.3, 1.5, all somewhat in the same ballpark there on current ratio. That quick ratio, which is current assets minus liabilities divided by current liabilities, it really sits, it moves, but it's relatively similar. Definitely the last 3 years, they've done a really good job keeping it well over 1, which is what you want to see. And of course, the thing we take in with a grain of salt on, current and quick ratio is how are they funding those current assets to be able to have that working capital. And as you look at both debt to equity and long-term debt, both of those trending down significantly, negative -3, -34%. So, I mean, definitely moving in the right direction there for sure. And I'd say after 2020, their debt to equity really got into a really, really good spot, being under 50 and even under 40 or 30. That's a great place for the company to be at moving forward. Most of their value is in their equity, not in, debt funding the company. Going back up, again, we're looking at working capital. Something I did a little differently on this video than I've done on others is inventory turnover and days inventory. This is just a metric that will loosely give you an idea of how much inventory is moving, how well they're efficiently getting inventory, essentially off the books, how they're spending it. And again, correct me on that. Go to Investopedia and just search it, and it can explain it better than I ever could. But, I try to put a goal there based on industry standards. Again, the challenge with Tesla is they don't just do automotive. They also do energy generation and storage. That energy storage is a really big part of their business that I have a lot of interest in personally. So these are based off of the automotive industry. So I think there may be some differences. And it looks like they're pretty consistent. So I wouldn't take too much negatives out of it. But the goal is 2 to 3. They sit right around 5 on their inventory turnover. It's decreased, which is, an okay thing, I guess. Their days inventory, that's your inventory turnover divided by 365. You want to see them moving. Essentially, this is how many days it takes them to move their inventory through. So you'd really like to see less than 60. Honestly, most companies, you want to see them turning over their inventory every 30 days. So it looks like they're holding more and more inventory over time. It's taking them longer to move it out of the door. But again, I you'd have to really dig into some of the footnotes on the annual report. I did skim through them. I just didn't sit too long on digging through some of these numbers. But you might want to go look at what does their inventory constitute. I do know the majority of it is automotive, and that's why I've kind of focused on it there in that respect. So as far as going past capitalization, we've already talked about that. I did mention at the beginning of the video, or I thought I did, but one of the reasons I've kind of haven't really dug into Tesla too deeply personally is just the lack of dividend. I do like to get paid by the companies I own. As part of my study of Benjamin Graham and others, I believe as a shareholder we have rights to the profits, and a company like Tesla, they're not dishing out the profits to their shareholders because they feel like the appreciation in share price justifies it, that they're putting those profits back into research, development, and revenue growth. So I think it is justified to an extent. I think at some point in their business cycle, dividends will play a bigger part, or they will need to play a bigger part. So hopefully shareholders can start getting compensated for the capital that they put into the company. That to say there's nothing there. So some noteworthy things. I went through the whole annual report. I tried to read it closely, but again, mostly skimmed. And, it's one of those things, I didn't plan on making a video today, but I kind of got a little spurt of energy there to look through Tesla, and got this all thrown together. So some noteworthy things, and some of this wasn't in the annual report. So this first thing was not. They have been working on using their charging attachment essentially for their vehicles as like the charging standard. They recently breached an agreement with Ford. That was the first one they had made, where essentially they would allow Ford vehicles to use or convert theirs to use the superchargers, the Tesla superchargers, which is a huge move towards the infrastructure being shared. it puts Tesla in the position that their superchargers become the standard. And I'll mention that there on that last square. But originally it was just Ford. Then right after my analysis of Ford versus GM came out and basically was able to announce that they had reached a similar deal. The way it looked like with them was that there would be an attachment vehicle owners could buy that would go on the end of their GM charger so they could plug into a Tesla charger. Either way, really big news. I saw an article earlier today that Stellantis is trying to consider whether they're going to look for an agreement on, something similar to Ford and GM on using Tesla infrastructure for charging. So that would be a really big deal. Stellantis is like the third largest automotive producer in the entire world. Not in the US, they're like fifth, but overall in the world, I mean, they put out a lot of vehicles, Dodge, Jeep, Fiat. A lot of those are under that umbrella in that company. So definitely a big deal as far as charging infrastructure. Right now, if you think, you ask a random person to name an electric vehicle, they're going to say a Tesla, probably 95% of the time. And so I think if they get to the point where you say, hey, name a charging station or a brand for charging station, and people say Tesla or supercharger, then you've cornered that market in a sense. I mean, there will always be third-party competitors, Ford and GM maybe jump into that as well, like they have with EVs. But regardless, if you become synonymous with something as a business, you've developed a competitive advantage that, while not tangible, while not something you really quantify in a number format, you have really created something special that's going to help your business continue to grow. Something I was impressed by is their development of modular electric storage. So they want to help. People will buy electric vehicles if they know they can charge them at home. Well, the problem is, if you're just charging, then with no way to store it, then it kind of becomes a problem because you're relying on the grid. You can't move, leave your house if, you have a power outage or something. So, I mean, the ability to store that, but also the ability to make it modular so that depending on the energy capacity needed, so especially for their commercial energy storage, being able to get it to where it's modular, industrial site can build it up to the point that they have gigawatts. That's a huge deal for them to have either a backup energy storage or a reliable electric energy storage. Something else I saw that was interesting in their revenue side is that they're starting to offer these in-app subscriptions. Maybe they've been doing that for a while, but definitely a good way to be getting that recurring revenue. You sell the vehicle or you have a used vehicle, you don't always get to control the used sales, maybe the servicing of those, but you don't always make the profit off the second user. But if there are in-app subscriptions to have certain features on your dashboard or whatever else that you have to buy from Tesla, well, now you're making recurring revenue even on vehicles that you sold 3 or 5 or 8 years ago. So definitely a good way for them to continue making money off of vehicles that most automotive manufacturers would have considered, inventory that's gone. So one of the concerns, the auditors had and comes up a couple times in the annual report is warranty reserves. So, obviously they provide warranties on their new vehicles, and it really just comes down to management being able to approve certain estimates for how much they will need to cover warranties. So it just depends, depending on how quickly or frequently they break down, or if they do recalls or anything like that, would mean they have to tap in. So it functions kind of like an insurance company. You want to make sure you have enough set aside that if there are claims, you can cover it. So hopefully they're doing a good job with that. One of the things I really like about their business model is that they're direct to consumer. They are serving consumers with customer-facing infrastructure, which again, it enables rapid adoption. It makes them synonymous with not just the product, but the infrastructure that's used to power the product. And customers are interacting directly with the company. That makes a huge difference in the types of relationships you can have. It's a double-edged sword, obviously, but it can really work in your favor if it's done right. So Tesla is a really good opportunity there as a provider of goods to build those relationships. Obviously, a big risk that comes up quite a bit in the annual report is supply chain issues or the availability of raw materials. They note that they rely on a huge swath of distributors for different products, and some of them are a single supplier that has they're the one that provide that thing, or they have options on some other things. So definitely chip manufacturing has been a really big thing the last few years, and the U.S. has tried to make some steps forward in bringing that back home, but regardless, there are some limitations there with things like that. And then also with providing batteries, there's really precious metals that go into building those batteries. And so just depends on how well we can mine those resources and do that sustainably. I found it interesting. There's a couple of notes throughout the annual report about Elon specifically that are not necessarily positive. Regardless, one of the notes, and I don't think there's necessarily internal turmoil going on at Tesla. I just thought it was interesting that it was signed off on to have these comments in there. But one of them pointed out one of the major risk factors for the company, in that major business analysis at the beginning of the report. They make a note that one potential risk toward the future well-being of the company is Elon Musk dividing his time as CEO. He also sits as the CEO for Space Exploration Corporation and with Twitter, which he recently bought. And so enough for them to note it means that it is a tangible concern. I know that Twitter really has taken a lot of his time recently, and so I could understand, having to make some kind of note about that to shareholders. And so, it'll be interesting to see over the next 5 years as he divides his time, does that affect Tesla, or is he able to kind of pass off some of his expertise to others? But it does note in there that they really rely on him to drive the company forward. And so, definitely a interesting relationship for a company. And again, I would compare there at the last square, I mentioned the Tesla Apple comparison, very driven by a personality in the CEO seat, which some companies are, some companies are not. But really driven by the personification of the company in an individual, as well as, again, being synonymous with a product. You think of a cell phone, you think of the iPhone. You think of Apple. You think of a good computer, you think of Apple. Again, but also the fact that they lean into the luxury side. Their goal isn't to just make a good product. They're trying to make one that is appealing to the eye, that just draws you in as a consumer and almost serves as a status symbol. I think that's something that Tesla needs to continue to lean into so that they can, continue to tap into that marketplace and to become a leader in that industry. Another note they made about Elon was, of course, the financial impact if he ever had to sell his shares. If he had personal obligations or had to maintain long-term debts, then he would have to sell off his, portions or blocks of his shares, and that would really negatively impact the value of the stock. I think that is, people really love Tesla or don't love Tesla, and it's not always because of the business itself. Sometimes it's because of Elon, whether they love it or hate it. And he can be kind of a polarizing figure. And so, the fact that he does control so much of the company, as a shareholder can be, I think, challenging for a lot of people and for the company itself moving forward. It is challenging having a controlling interest by an individual rather than by either another company or the company itself. And then also, when I was going through the audit report, looking in the notes about litigation, there was a sizable section, I think it was like a page and a half, about litigation that started in 2018 that still has not been resolved, surrounding Elon Musk making a tweet. I think, I don't know that he was joking, but he made a tweet about possibly taking the company private because of pressure that other people were giving him. And, they came out and were like, no, we're not taking it private. But it caused enough stir with shareholders and others that he was sued by multiple organizations, some of them large financial institutions. So I would be interested to see what the potential contingent liability would be if that lawsuit comes out negatively. How is that going to affect Elon and Tesla as a result? Again, if he was the one liable to pay considerable amounts out, he might have to sell shares. So again, a interesting concern there. Going into competitors, it really just doesn't seem fair to compare Tesla to other auto manufacturers. But of course, we can look at Toyota, Mercedes-Benz, this German company, Ford, Ferrari, General Motors. They all pay dividends. They all have significantly lower price earnings ratios. Ferrari is the only company that had higher gross profit margins than Tesla did. So something to consider there. But they all lag in terms of revenue growth over time. They all lag in terms of tangible book value increases over time. Most of them look like healthy companies, so worth looking into. I was really interested seeing some news on Toyota looking into solid state batteries to essentially make it to where you could charge your car in like 15 minutes compared to however long it takes right now. So, I mean, these other companies are trying to break into that space, Ford and General Motors especially. And again, that's part of why Tesla has to continue to be innovative, continue to grow those revenues, so that they can compete with these big, huge companies. I guess I could have put Stellantis in there as well with Chrysler and some of their other brands. But that to say, I mean, there's these other companies and they look more like automotive companies than Tesla does, and that's part of why their statistics look the way they do. So I hope you've got something out of this video. I would love your feedback. If you're wanting to see a specific company covered or analyzed, or a comparison between two well-known brands or competitors, definitely drop those in the comments. If I said something stupid, which happens, drop that in the comments so I can correct it and make sure that I'm not making those same mistakes. If my numbers are off or anything like that, definitely drop those in there as well. I would really, really appreciate it if you like this video, if you've enjoyed it, and especially if you listened this far. And then as well, if you would subscribe to my channel, that always helps as well. And that helps you so that you don't miss out on, future comparisons, especially if there's something you're wanting to see. If you subscribe, you can make sure that you're going to catch it when it comes up. So, appreciate you guys. I hope that you'll take some of this and apply it yourself, and go out and read those annual reports. And as I always say, dig in and invest well.